Welcome to Sifter Fund's quarterly review. In this presentation, we will cover three topics. Firstly, the fund's performance. Secondly, the top contributors and detractors during the second quarter. And finally, we will introduce you to one Sifter company we have been invested in. The fund's share price has returned 17.3% year to date and 4.2% in the second quarter and continued to rise by 3% in June. There has been a lot of discussion in the media whether the stock market is a bull market or are we expecting to see a crash and a bear market this year. To be honest, we don't know, and we don't put any effort into trying to speculate on that. Sifter Fund's investment principle has remained the same already for over 18 years. The fund is a long-term investor in a small number of quality businesses globally. What we care about is the quality of the businesses and their money-making power in the future. We think that the very strongest businesses will do well in all market conditions, and therefore we want to own them for a long time. Let's review a few of our businesses and how their share prices have performed during the second quarter. Top contributors of the fund companies were Novo Nordisk, Alphabet and S&P Global. Novo is a Danish pharmaceutical company that is market leader in diabetic drugs. Novo gave a full year guidance increasing revenue about 6 to 10% and operating profit to be increased by 5 to 9%. Novo's gross margins are stunning 80%, which is quite typical for a successful pharmaceutical company. Also, return on invested capital is astonishing 60%. We consider Novo a quality business because of its strong money-making power, which is supported by high barrier to entry and strong patent protection. Alphabet is better known as Google to most of us. Google's main business is online advertising, which is about 80% of the company's revenue streams. It generates over $150 billion annually from Google Ads. Google has been the market leader in online advertising for well over a decade, and it commands about 29% of global digital advertisement spending in 2021. Its lucrative digital advertisement business is supported by YouTube, which is the smallest of Google's three main advertisement revenue sources. However, YouTube is growing more quickly than the company's other major ad sources. Their fastest growing business is Google Cloud. However, this segment is still operating at a loss, but the operating loss percentage has been decreasing quarter by quarter. All in all, we consider Alphabet to be a very stable quality business. Despite its huge size, it's been able to be innovative by launching new revenue sources in addition to its core segments. S&P is one of the biggest players in credit rating sector, competing with the Moody's and Fitch. The reason we invested in S&P 4 years ago was its clear focus and stable and growing profits. However, in spring 2021, S&P announced a merger with IHS Markit, and we decided to decrease S&P's position in the Sifter portfolio. In our opinion, this merger causes risk for the company, and we think S&P will lose its focus and margins will decline in the future. The largest declines in share prices in the Sifter portfolio were seen in these three companies. Nitori is sometimes called the IKEA of Japan, and it's the newest addition to our portfolio. The investment was made in February 2021. Despite a small decline in the share price, Nitori's business is on growth path, and we believe that the company fundamentals are very strong. In a quarterly report published at the end of June, Nitori kept the guidance for the whole year unchanged, forecasting still strong 22% revenue growth compared to the last year. Growth is supported in particular by recently acquired Shimatsu hardware store, but also the growth of Nitori's store network in Japan and China. Net sales growth of Chinese stores during the past quarter has been faster than Nitori's own expectation during this quarter. Canadian National is the largest railway company in Canada, in terms of both revenue and the physical size of its rail network. The reopening of the economy in 2021 is expected to be good for the business. Based on its history, the company is able to raise freight prices more than inflation. During the second quarter, Canadian National announced an acquisition of another railway company, Kansas City Southern. This acquisition would make Canadian National one of the biggest players on the continent. Well, we see that the company is able to execute the massive merger and benefit from the expanded network from the Mexico to Canada. Koito Manufacturing is a Japanese company which is engaged in manufacturing of automotive lighting, such as LED lighting. The company is partially owned by Toyota. The company gave its quarterly report in May and revenue didn't rebound as strongly as the light vehicle production in its key market, China. As typical, the company has decided to give a very conservative guidance for the next fiscal year, and we continue to reevaluate Koito's business model and money-making power in the future. Next, we will take a closer look at the largest retail investment in Sifter portfolio. Please, Alexander.
Thank you, Santeri. My name is Alexander, and I will now present to you one very special retailer, one which has a significant, unique business model that gives this business some special advantages in this field. The business in question is Costco, which originally is an American retail chain, but today a global enterprise with a presence in 12 different countries. Now, this is a normal retail business that sells a wide variety of goods, ranging from hardlines to perishable foodstuff, but it's indeed dissimilar from its retail peers. And the main differentiating factor here is that Costco is run as a membership business. You cannot enter a Costco warehouse without having a valid membership card. Now, as you see here, for example, the store design is very simple. The various goods and products are simply left on their shipping pallets they arrive in and left as is in the massive Costco warehouses. Furthermore, the opening hours of this business are more limited than the competitors, and the staff working in the stores are few and far between. So why then would a customer choose to shop at this location, given that you need a membership to enter, the stores don't look like anything fancy at all, and it's hard to get a hold on a Costco service employee? Well, simple. Costco has by far the cheapest prices in this sector, even when you account for the annual membership fee, which is about $60 per year. So what makes us so happy about this business? Well, there's three main things working in favor of Costco as an investment case. Firstly, it has a differentiating business model from its competitors. Secondly, it has a very seasoned management team and a very good company culture of not wasting investors' money. And then thirdly and lastly, this business is very predictable, and even though it might seem a little bit expensive today, it is characterized by very low risk and good counter-cyclical characteristics. Now about this first point in more detail, about the business model and how it differs from its peers, we can look at these three charts here as an example. We see Costco is outperforming its competitors in return on investment capital, sales per square footage, and organic sales-store sales growth. Now these first two factors are caused by the company's operational model. This business keeps everything simple. We can also see that this business is utilizing its sales floors very effectively and therefore has to spend less money on property and related expenses. Another fun fact here is that this company does not spend a single dollar on marketing expenses. All the customers of Costco find this business by word of mouth alone. And these customers of Costco are likewise very loyal. The average retention rate is 90%, or in other words, the average customer stays with Costco for 9 years. And this concept is still gaining traction in the US and across the world. We can see this from the ever-increasing revenue growth and also from the same-store sales growth, which is far outperforming its peers. And we believe this trend will continue in the future as well. And the key point about this business is its business model, which is self-reinforcing in a way. The business is attracting customers because it has the lowest retail prices. And as it gets more customers, this company gets more scale and scale advantages. For example, in sourcing and in lower overhead expenses. This leads to further cost savings. Now the point about this business is that it doesn't generate any money from the retail operations. It takes these cost savings and return these to the customers in the form of lower prices. Now this in turn will attract new customers to Costco as the price point compared to competitors goes lower and lower. And in turn, this will lead to more scale efficiencies in the future, which will lead to more cost savings and so on. This is how the Costco flywheel is turning and going stronger and stronger every year. Now the second factor working in favor of this investment case is the management team and its strategy. Unlike some of its competitors who dive headfirst into new markets and surprisingly often have to shut down these new ventures after just a few years, Costco is very careful at expanding their business and it chooses its new locations very carefully. On average, the company opens 25 new stores per year. Most of these are in the US and North America, but it also expanded internationally. For example, they have stores in Iceland, France and UK and a few others. So far, they have been expanding at a very slow pace and have so far not had any single setbacks or store closures. And the most recent market that Costco entered was China, in which they entered their first store in Shanghai in 2018. This venture went far better than anticipated by the management and investors alike, as the single store got 200,000 new members in the first quarter of operations alone. This is way above the average success rate for a new Costco store. And due to this, the management has accelerated its expansion plans into China, and now they are aiming for 5 new stores within the next few years. 2 of these are already being built. And the last point is about the predictability of this business. As I mentioned, most of the profit from this business comes from the membership revenue, so we can focus mostly on this metric alone. The average members per store is around 60,000, and this number is continuously increasing year after year. New members also come from new stores, of course, whether these are domestic or international stores. Then lastly, you can take the number of members multiplied by the members per store, multiplied by the annual membership fee of $60, and then you get the revenue from membership fee, which is the most important factor to track when it comes to Costco. For example, as we see here, we expect revenues to grow by 7% per year over the next 5 years. Again, this is mostly modeled using the number of stores, the number of members, and the average annual membership fee of $60, which is tightly linked to the inflation index. Furthermore, we assume that the margins will remain stable, as any future cost savings achieved from scale will be passed back on directly to the customers in the form of lower prices. Therefore, the membership revenue continues to be the most important metric to follow and to forecast. And to conclude this presentation, I can say that Costco is operating a niche business model in the traditional retailing space. It has a self-reinforcing business model, and the company's competitive advantage is growing ever stronger every year. We at Sifter invested into Costco over 1 year ago, and so far the stock price development has been positive. However, it has not been as good as the general market index, which has been performing better due to the more cyclical nature of the global equities in general. However, we are still very happy with this investment, and we believe that this company is significantly less volatile as a company and should perform well in most market conditions going forward. I hope this presentation has given you better insight into how we at Sifter are looking at companies and investments. If you are interested in reading more about Costco, you can find our full report on this business from our website. Thank you, and we wish you a good summer.